Bitcoin and other cryptocurrencies are getting ready for more gains as stocks try to add to their recent gains. Several macro factors drove the recent rise in a number of asset classes, but experts disagree about how long the current bullish trend will last. Many people have been waiting for a long-awaited slowdown and a return of the 2022 bear market, but neither has happened so far in 2023. In fact, most assets have found buyers, and on July 12, the Nasdaq hit a 52-week high. How is this possible? Will the rise go on? Michael Burry, who wrote The Big Short, said in January that the U.S. could be in a recession by the end of 2023 if the Consumer Price Index, CPI, went down and the Federal Reserve cut interest rates. The CPI came in much lower than expected last week, which helped the recent rise even more. He thought this would cause another rise in prices. In a newsletter that came out this month, independent macro and crypto analyst Lynn Alden talked about the subject. In the study, Alden looks at inflation by comparing it to the 1940s and the 1970s, two times that were similar but different. From this, she comes to the conclusion that the U.S. economy is likely to stop growing or go into a mild decline while inflation stays at some level. This could mean that the markets will keep going up until there is a real slump. The Fed's fight against inflation goes on. Alden thinks that fast bank lending and big monetized fiscal deficits, which are the main differences between the two times, are the real causes of inflation. The first one happened in the 1970s when baby boomers started buying homes. And the second one happened during World War II to help pay for the war effort. The 2020s are more like the 1940s than the 1970s, but the Fed's monetary policy is still based on what worked in the 1970s. This could end up doing more harm than good. Alden says, so. When the Federal Reserve raises interest rates, federal interest costs go up and the federal deficit gets bigger. This is ironic, because deficits were the main cause of inflation in the first place. It could be like trying to put out a grease fire in the kitchen with water. Which makes sense, but doesn't work the way you'd think. In other words, new federal debt, or what some people call government money printing, is the main cause of inflation today. The Federal Reserve has raised interest rates by 500 basis points in a little more than a year, which has cooled some parts of the economy. However, the Fed hasn't done anything to fix what's causing inflation in the first place. With a debt-to-GDP percentage that is much higher than it was 50 years ago, things will only get worse more quickly. But markets have stayed strong. Even though the link between tech stocks and cryptocurrencies has broken. In this way, the Fed may be using a tool that isn't right for the situation, but this hasn't stopped markets, at least for now. Big tech beats predictions of a slump and drives up stocks. Even though the Fed is fighting inflation and the market thinks a recession is inevitable, the first half of 2023 has been a good time to buy stocks, and the rise has continued into July. Yields on bonds have gone up again, and risky assets like tech stocks have been going up like crazy. It's important to remember that Nvidia, Apple, Amazon, and Google are among the 7 stocks that have led this rise. These stocks have more than their fair share of the Nasdaq. Increasing interest rates can help stop inflation. But it only works for inflation that is caused by a rise in credit tied to bank loans. Higher rates bring down inflation by making it more expensive to borrow money and lowering the number of loans given by the private sector. However, they make fiscal deficits worse by increasing the amount of interest that is owed on debts. The government debt is now more than 100% of the gross domestic product, GDP. In the 1970s, it was only 30% of GDP. Related, Bitcoin mining stocks do better than BTC in 2023. But on-chain data points to a possible stop. Bonds fell, but crypto and tech went up. Bond market liquidity has improved, which has helped the rise in tech stocks, which has been driven in large part by talk about artificial intelligence and a few megacap stocks. Alden says this started happening late last year. But then, at the start of Q4 2022, something started to change. The dollar index went down after the U.S. Treasury started putting money back into the market. This was done to counteract the Fed's quantitative tightening. The S&P 500 found its bottom and started to get back to normal. Liquidity started to get better on the markets for state bonds. Assets that depend on availability, like Bitcoin, went back up. A study from Pantera Capital on July 11 makes similar points. It says that real interest rates have also changed a lot since the 1970s. Traditional markets may have trouble, but blockchain could be a safe haven, says a report. This is because the Fed needs to keep raising rates because real rates are still at minus 0.35%. From this, the study also says there's still a lot of risk in bonds. The study goes on to say that unlike most other asset classes, crypto is not affected by changes in interest rates. The collapse of over-leveraged centralized entities in 2022 caused Bitcoin to be linked to stocks. Today, the link between the two is almost non-existent. One of the most important things to learn may be that risky investments seem to have a bid under them for now. But this trend could easily change by the end of the year. Pantera Capital's Dan Moorhead said it well when he said, "After 35 years of trading, I've learned that the market can only go down for so long. Investors can only take so much pain. Since Terra Luna/SBF/etc., it's been a whole year. It's been long enough. We can get together now." With the split coming up soon and the possibility of a spot Bitcoin exchange-traded fund in the near future, crypto seems ready to break out in almost any situation.